The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. I'm Steve Sedgwick with Karen Cho and Arabile Gamede, and these are your headlines. The Dow and the S&P 500 close at fresh records, whilst the Nasdaq posts its fourth positive quarter in a row, as the Fed Chair Jerome Powell says they're not in any preset course for rate cuts.
This is not a committee that feels like it's in a hurry to cut rates quickly. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Japanese equities, let's take a look. Up 2% for the Nikkei, recovering some ground as Shigeru Ishiba is set to unveil his new cabinet after being sworn in as Prime Minister.
50,000 U.S. port workers begin their first strike in almost 50 years in a move analysts say could cost the U.S. economy $5 billion per day.
Israeli forces start targeted ground operations inside Lebanon, with the IDF saying it will raid Hezbollah targets and infrastructure in the south of the country. ECB President Christine Lagarde says she welcomes cross-border bank mergers as a boost to global competition, as Unicredit continues to court Commerzbank.
I believe that cross-border mergers, if they produce larger institutions that are more agile, that have more scale, that have more depth, has lots of benefits.
Farewell to September and hello to October and the end of the year, the final quarter here. Who would have thought? And so obviously the stretch now, we start talking about holiday spending, Santa Claus rally on the back
of Americans can spend.
Exactly. Port strike coming up.
I mean,
will they be able to get the merchandise?
The strike, which we'll spend a bit more time on later on, and there's a terrific piece on CNBC.com actually, is extraordinary. So much American apparel, foods, footwear, auto components go through these ports as well. After 2 weeks, things start getting a little bit interesting.
Well, it tests the narrative that we know. I mean, we've come off the back of a lot of Fed meetings that you've got cooling goods inflation, that some of the consumer spending is starting to wane from here, and we have question marks over the economy and workers in particular. So now you have strike action where there are fairly significant wage demands here. Does it also crimp supply chains that have started to correct on the back of the COVID situation? And what does the worker side look like? You've got one quarter that's shutting the country down and arguing for huge pay increases at a time when you've got a weakening labour market.
Yeah, it ain't just about pay rises, though. This goes back to the birth of industrialisation. This is about automation. This is about technology as well. And if I was in the longshoremen's union as well, I would be worried about automation as well, because you've seen it in some of these Middle Eastern ports and some of these Asian ports. You can automate an awful lot of the crane technology now, and you don't necessarily need workers on the docks.
Yeah, indeed. And let's push on and take a look at what we've had for the quarter as we wrap up the third quarter. It was a fairly stunning one for some quarters of the markets. And what we've got yesterday as we closed out the session, record levels on the S&P 500 and on the likes of the Dow. So closing out the quarter on a high, very small percentage gains, though, as you can see. It was about 0.4. It was the best of it on the charts. And this is what it looks like for the end of the quarter, those 3 months. And it was really a story of some breadth coming back into markets. You saw the Dow rallying to the tune of 9.5%. The S&P 500, similar range. The Nasdaq there too, but I think the market was looking at just a little bit of a stretch away from the Mag 7 stocks, with other sectors coming to the fore, and you saw that really across in various different parts. I mean, there's materials at the end of the trade thanks to the China story. There's a little bit of energy before that faded. Utilities got to a record close, so there was a lot of movement around other areas of the market. I mean, over the month, for instance, consumer discretionary was on the front foot. So when would we have mentioned any of those sectors previously. It was really just about technology.
Discretionary is dominated by Amazon.
Yeah, true. But there was a lot of tech, I think, prior to that, the first quarter and the second quarter. So a bit more breadth was the angle. What we saw in treasuries, the first action, of course, from the Fed, the jumbo-sized rate reduction. Now, the 2-year, where we approached at this point, 3.63 is where we kick off a brand new quarter. The 10-year, 3.78%. I want to take you to the Asian markets, ex-China. We've got, of course, on the back of what was a very strong rally for those markets on the China story. Now we've got the Nikkei in Japan trading up by 2%, a little bit of recovery trade there. It feels as though the Chinese story is still a lot of thunder out of the region, and the politics has been challenging around the incoming Prime Minister for Japan. But it is a day in the green. Elsewhere, red on the Australian market and across on the Nifty 50. The TAIEX down trading up 0.7%. Let's take a look elsewhere too at some of the other Asian markets for the quarter. You can see Hong Kong, double-digit gains. That is a 16% jump that you were seeing there. Shanghai Composite was off a low base, and we have, of course, seen a lot of action, but it was an 8% rally. Very small window to trade this. Shenzhen, same story, 11% higher. The window was incredibly small where you saw those gains coming through. To US futures, the early picture today looks like this. We are giving back some territories, the early indication. Slight slippage at the start of trade.
I've just gone down a rabbit hole just because I was questioning how much Amazon is part of consumer discretionary. And I'm just looking at various articles as well. Tesla plus Amazon equals...
strange, isn't it, having Tesla?
I'm with you. But Tesla, no stranger than household goods in Europe having all those luxury names. Yeah. Maybe in the Cho household, as I've mocked for 10 years now. But Tesla plus Amazon in the discretionary sector is 41% of the ETF weighting. Wow.
And kind of strange when you've also got cloud services.
I mean, there's others in there as well. There's Walmart, there's the card providers, but yes. Extraordinary. Anyway, let's go back to the basics. Fed Chair Jerome Powell has played down expectations that the central bank will keep lowering rates as aggressively as the recent half-point cut. Instead, signalling 2 more smaller cuts before the end of the year. Speaking before an audience in Nashville, the Fed chair said he sees inflation easing and the US economy continuing to grow strongly. The dual mandate very much in place, putting the FOMC in no hurry to cut rates too quickly.
We will do what it takes in terms of the speed with which we move. But if you look at where we were 2 weeks ago, coming up on 3 weeks ago, I guess, when we wrote down our SCPs and made our decision, it was a situation where people were thinking, the bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data, but ultimately that's what the baseline is. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Okay. That's unbelievable bit of clarity, isn't it? Try getting that out of Madame Lagarde. However, the Atlanta Fed President Raphael Bostic, that made him sound French there, says he's open to another bump of 50 basis point cut in November, especially if job growth slows faster than expected. Speaking to Reuters, Bostic said a surprise to the weak side could justify another larger move. This week sees a flurry of jobs data out of the United States, starting today with the JOLTS numbers and culminating with Friday's non-farm payrolls. Max Kettner is Chief Market Multi-Asset Strategist at HSBC. Max, nice to see you, sir. I hope you're well. Okay, we're in the last quarter, as Karen pointed out. My children have already started putting their lists together. I've told them don't even come to me till late November. But the point being, more importantly, how useful is looking back at the last quarter for what we should be doing in this current quarter?
Yeah, good morning. I think it is useful because I think when we look at the last quarter, one of the things that I would expect is after a quarter such as we had, particularly in the last 2 months, of course, you would expect that at least some of the sentiment and positioning indicators are a bit stretched. So that in that regard, I think it is useful because I have rarely seen that, high yield spreads continue to tighten as much as they do, investment grade credit spreads tighten as much as they do. Emerging markets doing the same. Now, the China story, the S&P goes from all-time high to all-time high. And yet you look at sentiment and positioning, at least to our suite of indicators, And they're really not sending any kind of warning signal at all. There might be some stretched technicals, but apart from that, it's pretty much neutral across the board. I think in that regard, it's pretty useful because that tells us there's still this underlying caution, I think, from investors. And that really, to us, speaks more about really further upside, particularly in equities, a bit more perhaps even spread tightening, at least spreads roughly staying where they are. And that generally is pretty good for risk assets, I think.
Okay, the start of August on Karen's watch saw a massive wobble. The start of September on our joint watch saw a massive wobble. Is October due a wobble as well?
I think that is the sort of consensus opinion, right? The consensus opinion is we have this sort of very weak, particularly second half September seasonality. Well, that didn't play out. We have the weak October seasonality that must be now exacerbated by the US elections coming up in November. And therefore, no one's really going to be willing to commit capital. No one's really going to look at the fundamental data. I think that's where I see the risk, that people are continuing to ignore really sound fundamentals, look at the nowcasts for GDP, actually look at, for example, earnings forecasts for the upcoming Q3 earnings season. Interestingly, when we look at it, excluding tech, you guys have been just talking about Amazon, you've been talking about Tesla, but if you exclude tech overall, then consensus is saying earnings are going to go down quarter on quarter in the third quarter, which to me is just insane. In a quarter where, the nowcasts for GDP still tell us more than 3% growth. So we're talking sort of 5 to 6% nominal GDP growth. And yet consensus is telling us earnings should have gone down. That to me is just such an incredibly low bar to beat in the earnings season that I don't think we're going to start with this wobble. I do actually think the reporting season starting next week, that actually is probably the next upside catalyst.
And Max, a low bar, easy to step over when it comes to earnings. What about on the data? Because Jay Powell was suggesting that it's going to be a quarter-point rate cut from here, which is very much on the narrative that we've got a soft landing coming and there's nothing more that the Fed has to rush. But what if we get an unwind in the labour market figures, because that's where the sensitivity has been?
Yeah, I mean, if we get payrolls in, let's say, negative territory, I think that would be the game changer. That absolutely would be the game changer, because then even if you're saying, yeah, but now we get 50 basis point rate cuts from the Fed instead of 25 in the next meeting, it would be sort of for the wrong reasons. It would be because growth really is falling off the cliff. That, however, I see very, very difficult to square with, jobless claims going towards 200,000. Temporary staffing index in the last couple of weeks really rebounding as well, right? You see job postings really stabilizing and slightly picking up. It's very hard to square and come up with a forecast of payrolls going negative. I would argue, look, if you've got payrolls roughly in line, call it plus minus 20 or 30,000 within consensus, that is as Goldilocks as it gets. If it's slightly weaker but still positive, right, that actually is still going to be good, because just like Bostic was saying yesterday, that might actually increase the chance of a 50 basis point cut in the November meeting. And that's then good for valuations, as long as it's not a blowout number. So if we got something like payrolls 250 or 300,000, that again wouldn't be particularly great. But it's also tough to square with, this sort of gradual loosening in the labor market that we would get a blowout number. And in total, look, the data really is strong. I do really think, and I'm not quite sure why we're not focused enough on that. When we look at the revision of the national accounts data last week, virtually everything got revised higher, right? GDP, gross domestic income. It was profits that were 9% higher than previously reported. Incomes, personal income, interest income, dividend income, literally everything has been stronger than we previously thought. And we're still talking about, is the US going into recession? And the reality just looks, the US keeps going from strength to strength.
Max, there are a lot of reasons still to be cautious, though, and the US political situation is one of them. A lot of fund managers keep on mentioning the election later this year. I mean, news flow this morning around this port situation, the strike, and whether we could have supply chain snarls. Isn't this a market that now you've got it trading around record levels? It is right to be cautious around some of these big events.
Yeah, I don't think so, because at the end of the day, when we compare it, for example, with the last couple of quarters, again, going back to your first question, is it useful to look at the last couple of quarters for the fourth quarter? Look at, for example, what happened in Q1 and the beginning of Q2. Even though inflation kept surprising to the upside, the S&P was still going up, high yield spreads, investment grade spreads, risk assets in general were really, really strong. even though the market kept pricing out rate cuts. It only really started struggling once the market said, hold on, are they really going to be able to cut at all? Or might they even have to hike? So once the pendulum really swung into no cuts or even hikes, that's when the market struggled. And we're so far away from that. Perhaps in a couple of months, perhaps sometime in Q1 or Q2, we might be talking about, goods inflation is coming back. Does that mean the Fed needs to take a pause earlier than we had thought? And maybe then we get some weakness. But up until then, solid strength, solid earnings, solid growth, Fed rate cuts, now China easing. I think that is really enough of a tailwind for risk assets in general to rally further.
Max, thank you very much for that. With us, Chief Multi-Asset Strategist, HSBC. Let me take you to the Japanese stock market. We are seeing a recovery trade play out today on the back of what has been a lot of red ink around concerns about Ishiba, the incoming Prime Minister. So we've got the market bouncing, so picking up off the lows, nearly 2% to the upside, and we are perched, as you can see, above 38,600 points. The topics also in rally mode, and just a quick look at the yen. Don't forget, this is where some of the tension has been. The strength that we've seen in the Japanese currency has just raised some concern around what some of those corporates are facing, particularly the big exporter stocks. So dollar yen morning trade is actually a stronger one. So a little bit of slippage in that Japanese currency in this session. We're 144 the level today. Let's take you to the latest around the politics as Japanese lawmakers are set to confirm the appointment of Shigeru Ishiba as the country's Prime Minister after the former Defence Minister secured the leadership of the country's ruling Liberal Democratic Party. Ishiba is expected to be formally appointed by the country's emperor after the vote today and hold a press conference this evening.
The incoming Japanese Prime Minister, Ishiba-san, is set to formally announce his cabinet shortly after being officially appointed as leader. Ishiba has reportedly selected Katsunobu Kato as finance minister, while Yoshimasa Hayashi will reportedly maintain his role as chief cabinet secretary. That's according to Reuters. It comes after incoming Prime Minister said he could call a general election later this month, a year earlier than scheduled. Arabile.
Well, coming up on the show, U.S. port workers on the east as well as the Gulf Coast go on strike, bringing billions of dollars worth of trade to a halt. We'll take a deep dive into the worldwide implications and what that means. Plus, the UAE's ADNOC is reportedly nearing a $13 billion takeover deal for German chemicals firm Covestro. We'll keep an eye on how that stock moves then as we head into the market open. And we'll be joined around the desk then by the interim CEO of one of Africa's largest lenders, that's Absa Group. That conversation with Charles Roussan is coming up at 6:45 BST. Stay tuned. This is Squawk Box Europe.
The Israeli military has announced troops have begun what they called limited, localized and targeted ground raids inside of Lebanon. US officials told NBC News that Israel informed them the operations is intended to push Hezbollah forces away from the border and target the Iran-backed militant group's infrastructure. The sources expect the incursion to last for days, not weeks, and be limited in scale and scope. Very limited movement on crude prices today. You can see we're 68.24 on WTI, about 0.1% to the upside. Brent hugging the 71.5 line.
Let us move on as well. A huge story. We mentioned it briefly at the top of the show. Members of a US dock workers union have gone on strike after failing to reach an agreement with port owners on a new contract, with industrial action set to impact billions of dollars worth of trade. Arabile, this is a huge story, actually. Well, no, hang on. At the moment, the ramifications are not enormous, but very, very quickly for the United States, they could become very big and potentially become political.
They certainly could be. I mean, so much so that even Federal Reserve Bank of Chicago President Austin Goolsbee has actually commented on this as well, saying that he'd be very, very concerned if this was to be a prolonged strike, because the impact could certainly be big. I mean, this is the first coast-wide ILA strike since 1977. Of course, the ILA being the International Longshoremen's Association union then. It includes around 50,000 workers at 14 ports across the U.S. East and Gulf Coast. Now, analysts at JP Morgan even say that the strike will cost the U.S. economy roughly $5 billion a day as shipments are disrupted. Now, the affected ports represent over half of U.S. container imports and 68%, that's 68% of container exports. National Retail Federation CEO Matt Shea told CNBC that the action could actually damage progress on inflation. So that's something to worry about.
It's a concern not only because of the impact on the retail industry, but because we live in a global interconnected economy. And so whether it's retail or automotive or pharmaceuticals or food and drinks, beverages, all those things are going to be impacted at a time when we're finally turning the corner on inflation. We know that the job market and overall economic activity has moderated from the highs over the last several years. And this is really the last thing we need as a self-inflicted wound as we go into the fourth quarter of the year.
So what exactly are the demands here then from the union? Well, the U.S. Maritime Alliance, which represents employers at the ports, offered a wage hike of nearly 50% over 6 years in a bid to restart negotiations yesterday. That was rejected by the ILA. Now, the union has called for a 77% pay increase over the course of the deal and a total ban on automation, accusing employers then of refusing to address a, quote, half century of wage subjugation. Now, Gene Soroka is the executive director of the Port of Los Angeles, which is not one of those directly impacted by the strike. But he told CNBC that workers need to be rewarded.
These dock workers have gone through a cycle where the economy has changed. Profits have been earned by companies that need to reinvest, and these dock workers need to get paid. So we hope for a swift resolution, make sure these folks continue talking, because collective bargaining is really hard. But the economic impact, I'm hopeful, is very short and we can catch up quickly.
Now, President Joe Biden has resisted calls to intervene in the dispute, with his administration saying that he would not use legal powers to delay action for 80 days. And urging both sides then to negotiate in good faith. Neil Bradley is the Executive VP and Chief Policy Officer of the U.S. Chamber of Commerce, which has called for Biden to step in.
If you have just a one-day strike, for example, that creates a backlog within these affected ports that takes on average 6 days to clear. If this strike goes on for 2 days, you're talking about 2 weeks just to clear up the mess that's been created. So it's not hard to imagine a situation where even a strike that only lasted 1 week actually disrupts the economy well into November.
So this is certainly a strike that, if does go on for quite some time, then could certainly hurt, but also hurt in terms of inflationary impact, as we've been noting as well, something that may be of great concern then for the Federal Reserve, but just not yet, guys.
There's so much to say about this, and it sounds incredibly brutal, but I'm going to have to be brutally honest about this. Yes, I have unbelievable empathy for anyone losing their jobs. I don't want to lose my job to automation, to AI. But the fact is, in the 21st century, if we can do something automated, this goes right to the heart of when I have all those conversations with all those AI geniuses who come on the set and say, well, what job's going to be created? Because they keep saying, oh, yeah, humans won't need to do X, Y, Z. It's going to improve our productivity. And I say, well, what job's going to be created? And the fact of the matter is, automation with AI, with modern technology, can do a whole host of jobs that us humans currently do. There's no doubt about it. but not wishing to be a Luddite, the fact of the matter is, what are we all going to do? Where are these millions, if not billions, of productive jobs that everyone's going to do? What can those longshoremen do if they're not doing what they're doing here? Where are those other jobs being created, freeing us up to do other things? And this is the prime example of something that's as old as the hills, ever since the late 18th century in the United Kingdom, and then later when the Luddite movement picked up, machine breakers and what have you. Automation, technology will replace many, many jobs, plus this AI. I just don't know what jobs are going to be created thereafter.
Well, some of it is about working alongside robotics as well. So it's not just an immediate cut the jobs and then replace with automation. So there is a staggered process. But I think what we're talking about now with a 77% increase before there's even a discussion taking place, it suggests that workers want to front load that money just in case it's the scenario that Steve's talking about. They are very much concerned about it. So I think in that context, though, as you talk about such a huge increase that impacts the business model, doesn't that just put the foot on the accelerator pedal towards automation?
Yeah.
Because you've got such a high cost base impacting the industry for a long time. It's not just 6 years, that is the starting point, then for fresh negotiations down the track as well.
I mean, it takes the conversation, as you say, just a little bit worse, because you're asking for that 77%, but then you're saying no further conversations around automation, when perhaps the conversation could also be around, well, if you're going to include automation, you need to upskill us to be able to be a part of that automation process, right? So you might then, of course, have job losses along the stage at somewhere. But if those port authorities have then invested in those employees to upskill them, ultimately making them part of the process.
To do what? To do what? This is exactly.
Well, here's the thing.
Get me a genius here on the show that tells me, another AI genius who can come on this show who can tell me where all these jobs are going to be going.
Well,
Go on, give me a great example.
Let me give you a simple example. And this is not just with AI, but just the advancement of things. So if you're going to be in construction, usually you would have had to have carried that big block of cement yourself, or rather the packet that has granular cement before you've added the water. Now you have cement trucks.
Right.
But now you needed...
Cement trucks have been around for a long time.
Fully agree. But what you needed to do once you got the cement trucks was you actually needed the people who are going to drive that cement truck and operate that truck.
So drivers of cement trucks have been around as long as I've been around.
Not everybody was able to drive, though. And what we're saying is that the upskilling in that process was necessary still, because not everybody was able to drive.
Huh? Sorry,
in those jobs.
I've never seen a construction site without a personally driven cement truck.
We're talking about something 50, if not longer, many years ago from here. But it's the relative process of upskilling that was it's a simple investment opportunity that people could get into. And I think the businesses will work from.
We've got to push on. I want to talk more next time too about the impact on inflation, because that's a big one for the economy. But for more, if you want to take a look at this story, it's fantastic. For more on the impact of the US port strike and the companies set to be most affected, check out CNBC.com. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.